Hello traders, you're welcome back to the Forex Geek channel. Have you ever heard that market prices are completely random and that technical analysis does not work? Well, that's exactly what the random walk theory suggests. But is this true? Wow. Well, if it is, does that mean trading strategies are useless? In this video, we're just going to be breaking down the random walk trading strategy, what it really means for traders, and whether you can still find an edge in the market. Okay, we're going to be covering what the random walk theory is and how it applies to trading. We're also going to be looking at whether technical analysis still works in a random market, how traders can adapt to uncertainty using price action and risk management, and the pros and cons of using a random walk trading strategy. Okay, so make sure to watch until the end because this is a game-changing discussion. And before we dive in, hit that like button, subscribe to the channel, and turn on notifications so you never miss out on high value trading content. Okay, let us get into it. Now, what is the random walk theory? What exactly is the random walk theory and why does it matter to traders? Now, the random walk hypothesis is the idea that market prices move randomly. Is the idea that market prices move randomly. So that is what we call the random walk. It's the idea that market prices move randomly. It might sound really crazy to some traders, right? I'm sure some traders might not have heard of this concept before, okay? But let's just discuss it, right? So, that the hypothesis, says that, prices are unpredictable. This means that past price movements have no effect on future price action, suggesting that it is impossible to consistently predict market direction. Now, this theory was made popular by economist Burton Malkiel in his book A Random Walk Down Wall Street, where he argued that technical analysis and even fundamental analysis don't work in the long run because the market follows a random path. If the market is truly random, it would mean price patterns are illusions, right? If the price of assets are really random, it would mean that price patterns are illusions. Does it mean that all we know about market structure, and the candlestick patterns, chart patterns, and all of that, does it mean that they are all illusions? Well, traders might see patterns, but they don't actually repeat in a predictable way. Well, that is exactly what these theories are trying to, assume. Well, if market is truly random, it would mean that no strategy works consistently. If price movements have no memory, then technical indicators and chart patterns don't provide an edge. If the market is truly random, it means that you cannot outperform the market. Since prices are random, the best strategy might be just buying and holding an index fund instead of actively trading. But is this actually true? Let us take a deeper look. Now, if the random walk theory were 100% correct, then technical analysis will not work. But as traders, we see certain patterns and behaviors repeat in the markets all the time. For example, let's talk about support and resistance zones. All right. Now, you will notice that prices tend to react at key levels, showing that past price action does have an impact on future movements. Secondly, liquidity grabs and smart money concepts. Talking about liquidity grabs and smart money concepts, we talked about that in a previous video, but let's just look for like a good example. Okay, so talking about liquidity grabs and smart money concept. Large institutional traders manipulate price to hunt retail stop losses, creating predictable price behavior, right? And then in terms of market structure trends, markets don't move in a straight line. It is already an established fact that the prices do not move in a straight line. It always moves in zigzags, right? There are always pullbacks. We have an impulse move, a corrective move, an impulse move, a corrective move, an impulse move, and so on. So while short-term price movements may seem random, longer-term trends, liquidity behavior, and smart money management, or rather smart money movements, are far from random. This is why experienced traders can still find an edge. But what if we actually tried to trade using the random walk strategy? What would that look like? Now, the random walk trading strategy is based on the idea that since price movements are unpredictable, traders should trade randomly. Instead of analyzing charts, just buy or sell at random and use probability to manage trades. That is the random walk trading strategy for you. And then, traders should focus on risk management. Since direction is random, the key is to cut losses and quickly. The key is to cut losses quickly and let winners run. So that is what the strategy is, presenting. You should trade randomly and you should manage your risk, because since the direction is random, you should be cutting your losses quickly and you should let the winning trades to run. And then the strategy also says that you should use statistical methods. Some traders apply concepts like Monte Carlo simulations to test how randomness affects their results. Now, while this strategy sounds interesting, there are a few major problems. One, no directional bias. If markets were truly random, we will not see trends or consistent price reactions at key levels, right? And then it ignores market psychology. Smart money moves based on liquidity and order flow, not randomness. And there is no real edge. If you enter randomly, you are basically flipping a coin, and trading becomes gambling instead of skill-based decision making. So does that mean randomness plays no role at all? Not necessarily. While markets aren't completely random, uncertainty is a real factor in trading, okay? This is why risk management and adaptability are crucial. Here's how traders can use elements of randomness to improve their strategies. First, accept randomness in the short term. All right, you can accept randomness in the short term. No trade setup is guaranteed. Okay, so instead of looking for certainty, focus on probabilities and risk to reward ratios, and then always use proper risk management. Okay, if some price movements are unpredictable, then stop losses, position sizing, and risk to reward ratios become even more important. Also, look for smart money footprints. Institutions don't trade randomly. Liquidity, order blocks, and market structure reveal their hidden moves. And also, test strategies with data. Instead of assuming randomness, use backtesting and forward testing to see how different strategies perform over many trades. So while the random walk trading strategy might not be practical, the concept of market unpredictability is something every trader should respect. The key is to find an edge where randomness meets structure. Alright traders, that is a wrap for this discussion on the random walk trading strategy. Do you think markets are truly random, or do you believe that patterns and strategies can still give traders an edge? Drop a comment below and let us discuss. And if you enjoyed this breakdown, don't forget to like this video, subscribe to the channel, turn on notifications so you never miss an update. Stay sharp, trade smart, and I'll see you in the next video.